Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, April 7th, 4:28 p.m. Eastern Time, coming to you from the financial capital of the world, St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in an uptrend that is hanging on by its fingernails to some key moving averages after pulling back and after having the Fed come out with a more hawkish approach to controlling inflation. We'll get into the details momentarily. The market kind of chopped around today trying to decide what its next move is going to be, but a lot of charts are broken and even fewer sectors are seeing money flows in their defensive sectors. And we'll check that out also. Let's check the trend gauge over here. Market leaders. We use the 21 over 21 list a lot for this, but also for some potential market leaders that have the capability of really seeing money flows into them should a sustained uptrend take hold. And we're still holding on to green with that, but the arrow pointing yellow more towards neutral. The market's next direction and the strength of sectors are going to dictate whether we come off of bullish on there. As far as the three time frames go, the five major indexes that we track in every video, short term hurting a little bit, along with medium term hanging on, but really we saw such a strong bounce that the way moving averages work is it's got to stop going down and then turn, and you can get really extended in there from there. And then as you get extended, you can pull back and still be above it, but it'd be a not so healthy pullback. And that's kind of what's going on with the 21 day. Still showing green, but yellow arrow pointing toward neutral. Medium, not quite as bad, but again, the yellow arrow in there. Long term, S&P 500 was the only index holding on to the 200-day moving average, and it's still holding on by the skin of its teeth. And you see the red arrow there. If we close the week 1% or more below the 200-day moving average, that'll move over to bearish / downtrend. So that's where we are with the trend. As far as what happened today, I mentioned chop, and that's what it was, a post-Fed chop day, direction to be determined. There was some good, there was some bad. Tim talked a little bit about the good last night in his video. From an index standpoint, the G6 basically flat on the day, up 0.1%. S&P 500 ugly most of the day, but rallied in the afternoon. Came off the highs over the last 15 minutes, still up 0.4%. NASDAQ 100, similar action to the S&P, red most of the day, but did finish positive, up 0.24%. Dow up 0.25%, mid caps down 0.2, Russell down 0.35. 60/40 global diversified stock and bond just barely positive on the day, as bonds down again on the day. TLT making new lows, but eked out just a barely positive gain. GROTECTION up approximately 0.24%. This varies depending on which portfolio you're in, how long you've been a client. So we approximate the return, but approximately up 0.24%. Let's get to the tail of the tape and charts of interest and the index charts. But first, let's get to the team here at Revere. Trend following, active management is what you get at Revere, participating in uptrends, getting a little more defensive, tapping the brakes during sideways markets, and getting the heck out of the way during downtrends. It's how you treat things in your life. We don't think your investment should be any different. We're technicians. We read the market based on a bunch of indicators that are time tested. And if you're interested in this approach, give us a shout. You can email Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or you can call 855-REAL-WEALTH. That's 855-732-5932. Right to the S&P 500 chart. Let's blow this up a little bit, and let's bring in the tail of the tape. So starting at the top, cautious uptrend, already talked about that. We've got no change in the headwinds, strong dollar, inflation, Fed tapering interest rates, Russia, Ukraine, put call sentiment, put call 0.9. That's it's in yellow for a reason. VIX on the elevated side, 21.5, but down a little bit today. Fear and greed also showing mild fear. So our bull case, I talked about hanging on by a thread a couple times, and we still are here. The 316 follow-through day, holding on above these moving averages. From a bear case perspective, if this rally would fail and we'd break moving averages, the bear case would overcome the bull case, and on the bullish side, the NASDAQ 100 cannot get above the 200-day moving average. That's a red flag because the NASDAQ 100 tends to lead up and it leads down, and when it's weaker, we're very cautious. So some news today, Fed's Bullard, he's the most hawkish of the Fed speakers. He says policy is behind the curve, wants 250 basis point rate increases by June. So that would be in the early May and then the June, the next two meetings. This guy's just not happy. I don't know what he eats for breakfast, but he should try some bacon maybe. So we're watching coming into the day, S&P 500 resistance, the 200-day moving average around 44.92. We closed yesterday at 44.81. It was a failure of the 200-day moving average, and support, the lows of yesterday, Fed day, 44.50. So what we did is we closed just above that resistance level at 4,500. You can see down here today's close, 4,500. As we tested and held the 44.50 level. So this is in green for a reason. Green is good. So a little bit of positive sign for the S&P 500. On the NASDAQ, on the other hand, came into the day pinched between the resistance overhead, the 21-day exponential moving average, and support below the 50-day moving average. It tested both, and it's still in between. So no direction determined on the NASDAQ 100. We're going to be watching both of these again tomorrow. It's critical to the next move of the market if you get a sustained move in one direction or another. As far as the action went today, let's take a look at a 5-minute chart on the S&P 500. Mild gap down. Little rally early, then just dropping lower, and look where we bottom, this 44.50 area. Support, just like yesterday, 44.50 was support. And then as if somebody flipped the switch, we just started rallying upwards to about 315, a little bit of a pullback, tried to rally again, and then pulled back into the close as some people decided to take some profit. So all in all, I'd say a positive day from the standpoint that we didn't break 44.50. And we did slightly close above the 200 and the 21 into the declining 8. That's the thin purple line here. So we need more information. Today's highs and lows are critical, just like because today's low held yesterday's low. So that's very that adds, every time something holds, it adds strength to it. However, if you get tested too many times, it weakens and you can break below, but right below there is the 50-day curling up moving average. So a lot of work to do around here. Putting in perspective the big move, the pullback to 44.50 is not bad. It's just right around the 38.2% fib retracement, which is very reasonable to pause around there, to pull back to there, and to find support there. So again, we could go either way here, but the growth portion of the S&P 500 looks like garbage, and we're going to look at those charts momentarily. So, notes on today. These levels are important to reference. Fed day, Fed minutes, the pivot 44.80. We were at 44.80 before the Fed minutes came out. We battled up and down around 44.80 after the Fed minutes came out. We battled up and down around 44.80 today. 44.50 acting as support, 4,500.04 acting as resistance, and I said we closed today right around 4,500. So really nothing determined based on today's action. Strength again, oil started strong, got weak, closed strong. Fertilizers continue to be strong, uranium strong today, gold and silver strong, defensive as an aerospace defense strong, cybersecurity strong, and the two strongest, staples and healthcare, by far the two strongest sectors within the S&P. Weakness, banks, that's KBE, also XLF and XLRE. XLRE has been acting great, but just gave up a little bit of that strength today. We're going to look at all 11 of the sub-index charts today, and biotech weak today. XLC also, which is the communications sector, one of the growth sectors, also weak today. So portfolio changes. We added XLV. Show that chart. XLV looks pretty good. Little cup and handle here, broke out above it, consolidated after the breakout, held the ADMA, took off today. We added to it, and we're up pretty quickly on that position. We also added Oxy. Lot of these producer charts, oil and gas producer charts, broke below their 21 and reclaimed it today. Oxy has superior relative strength and insider buying. As you can see, these little plus signs here. So we went with that. Really could have went with a couple. Devon was under consideration, but we went with Oxy. The good thing about this, below today's low, is a quick and easy stop. We're always looking for low risk entry, especially in this market. Let's talk about when we got defensive during the day, a little bit of a head fake. We sold SPLG when we tested and broke back below the 200-day moving average early. And then we rebounded, got right back above it. So the crazy thing about the 200-day moving average, and it's such an important area that you really have to give, and this is the case with most moving average, you got to give plus or minus 1% either way. When I was studying bear markets, we insisted on the 1% or more close below to avoid fake outs, close to end the week below to avoid fake outs. So plus or minus 1% below here, the level is right around 44.90. So on the upside, that'd be 44.35. Today's high was 45.21. 45 points below, 1% below 44.90 is 44.45, which is right below today's low, 44.50. So 1% either way, you're going to bounce around the 200-day moving average. How we close the week is important, and then when we get a sustained direction, plus or minus 1% in either direction, that's when we can make more substantial investments from a tactical standpoint. Of course, if the trend changes, or if the trend stays sustained, tactical entries can turn into strategic. So bottom line today. Oh, also we put on a short when we broke below the 200-day moving average and tested it and failed, and that was SH, which is the inverse of the S&P 500. So down a tiny bit on that. We also got stopped out on the final piece of our Tesla position, and then when the market gathered strength and got back above the 200, we looked at leading stocks that were near low risk entry points. Apple jumped out, the only one of the big top 10 NASDAQ 100 stocks that have held the 21-day exponential moving average. So we took a position, nice low risk entry in Apple. So those are the changes today. So bottom line for today, market ping pongs around key moving averages, next direction to be determined. Let's go through the rest of the indexes here. NASDAQ 100. There's your support at the 50-day moving average. There's your resistance at the 21-day moving average, stuck between the red line and the green line. So, and really 2 days right around there. So we got to see how that resolves. Let's go to the Dow Jones Industrial Average. Undercut, reclaimed. The 21-day and the 50-day today ran into the declining 8. So really this is an outside bullish reversal with the close above yesterday's high and taking out both the highs and the lows. We'll see again how this resolves, and this being one of the more defensive indexes. I would expect relative strength if we continue to see the money flows that we've seen into the defensive sectors within the S&P 500. Mid caps, MDY, yikes. Undercut, well, this is what, 5 out of 6 days down off of this failed gap up. We did bounce. We did get a hammer out of the day. That's when you bounce strongly off the lows and close near the upper range. IWM, small caps below all moving averages, 2 days below the 50-day moving average. Let's look at IWO, which is the growth part of the Russell 2000. Looks very similar to the overall IWM. Let's look at IWN, the value component. That really doesn't look that good either. So not getting much out of small caps is the bottom line from the takeaway there. So let's go through all 11 of the spider sectors, go through them in alphabetical order. Basic materials, this one chops all over the place, but it is holding the 21-day moving average, not seeing much relative strength either way. Look at note the relative strength line on all of these. This has good days and bad days, but it is very choppy. XLE is next, has been the leader for a while, but not a leader for the last 2 to 3 weeks as we're consolidating. This up move, sideways, this up move, sideways. Where are we going to resolve? Consolidation should resolve in the direction of the primary trend, which for energy is up. No guarantee, however, but let's see these very clear 2 bounces off of the 21-day exponential moving average. Today's lows need to hold, or we're going to test the 50, and that'll be a little bit of a more deep correction in energy. XLF, financials are next. These do not look good. Look at the extreme lack of relative strength over the last 3 weeks. This is because the tightening of the interest rate curve. Banks like to borrow low and lend high, and when the curve tightens, they can't do that. So not too many bank charts look good. So I would call XLF an avoid. XLI is next. This has been bouncing around also similar to XLB, but in a downtrend lately. A lot of that is because transports IYT, which is a big percentage of the industrials, just looks like absolute death. 6 straight days down, but it did bounce at this 240 area, which has been support for about a year. So we're going to set an alert at 240 on IYT just to let us know what's going on. So that's XLI. XLK Tech. I know I skipped XLC. I'm going to show that in a minute. XLK Tech, take a look at this chart. When we were coming back up off the lows, Tech led the last couple of days, and actually since the high last Monday with this big, on 329, that was Tuesday when we had that big gap up. And then Monday, where we thought we had some strength with Tech before really a weekday on week WEAK day on Tuesday, another weekday after the Fed. We did kind of hold the lows here and close right on the 50-day. The 3 tech sectors are XLC, XLK, and XLY. XLC is a communication sector that looks much worse than XLK, below all moving averages, and XLY, consumer discretionary, typically weak when you're in a recession, and we've got high interest rates and high inflation. Not a good combination. CKY, think Chucky, whatever the names of those movies were that Chucky was in, but it looks like Chucky because Chucky's not a handsome doll, and certainly not a handsome picture on the indexes either. So CKY is Chucky. Let's see, XLK, XLP. Here's where the money flows are. PRUV and XLRE. These are where the money's flowing. Look at the improvement in the charts and the relative strength of consumer staples near all-time highs. We know the S&P is not near all-time highs, so big outperformance in staples, and that's the market getting defensive over the last 2 weeks. XLRE, despite interest rates rising, XLRE relative strength over the last 2 weeks has also looked pretty good. Pull back today, but an inside day. XLU utilities, again, despite interest rates, XLU showing extreme relative strength over the last 3 weeks. And XLV healthcare, serious relative strength over the last 2 weeks, with a big breakout today and a move to all-time highs. So healthcare, staples, real estate, and utilities are the four that are working. They're defensive. The market can at best tread water if these are going to continue to lead, because tech makes up the biggest part of the S&P 500. So that's why we bought XLV. We can be short the S&P and be long healthcare and get some alpha out of that, because healthcare is what is outperforming, and that's kind of how we're positioned right now. But if we seriously reclaim 4,500 back above the 200-day moving average, I'm going to show that again on the S&P. That means we're going to get some cooperation from some of the sectors that have been lagging lately, and we'll change our stance. We're not married to anything. We interpret the charts, and whatever direction they go in, we've got a plan. So let's see. Costco did us. Let's look at a couple charts of some things that we own. Costco doing what's right for America, breaking out to all-time highs today. Got a couple of price target upgrades and reported stellar same-store sales. CVX we still own. We've owned it for a while, not making much progress, but look how it consolidated tightly here into the 21-day back in the middle of February before taking off. It's kind of doing the same thing here, but wants to take off, we're okay with it. We also added Oxy today in the oil patch. I mentioned that we punted on Tesla. Let's show that chart. When it undercut yesterday's lows, our cost basis was right around 1,005. We wanted to lock in some profits on it, so we got rid of it. This can set up and be a leader again, and if it does and makes that move, we'll be participating with it. So let's wrap it up here. And as always, love to hear feedback from you. You can email me, don@revereasset.com. If you call, you're going to get Dan the Man. That's 855 Real Wealth. And that's it for wrapping up Thursday, April 7th. This is Don Vandenbord telling it like it is. Hunter will have the big show tomorrow. We'll have quite a few updates for the 21 over 21, so be sure you tune in for that. Thanks for listening. Have a great day.